In this chapter, the main concept that you really need to learn is the closing entries. We do this at the end of a period when we want to make sure everything is closed out to start all over again. That is why we also have to understand how we are using these worksheets that we've done in previous chapters to build the financial statements and what each account represents. So let's go through as a review and fill in by account whether it shows up on the income statement or balance sheet and what its normal balance is. For example, revenue is going to be on your income statement and it's going to have a normal credit balance. And you'll see why this is important that we keep drilling this down to know what your normal balance is in these accounts. So fill in the rest of that as practice, and we're going to then talk about these closing entries. So closing entries, it helps to define what is a temporary account and what is a permanent account. That should have changed on your example. So a temporary account, again, go in, make sure you write in your own words the definition of that temporary account and give examples of accounts that are temporary. Your temporary accounts will close at the end of a period, whereas your permanent accounts, those stay open. You also have to learn about this new account called Income Summary. This kind of captures those revenues and expenses. Make sure you understand what that is, and it's used only in that closing process. And finally, we talk about the closing entries, and after we do these journal entries, the point is that each of these will have a zero balance after the closing process is done. Closing entries have to go in a particular order. We close our revenue, then we close our expenses. These are both closed to your income summary, that new account that we just learned about. Then we close our income summary account, and we close those dividends accounts. These are closed to retained earnings. So now we can look and say, well, what kind of accounts are left? You know, our revenue expenses are income statement accounts. Dividends are going to show up on your retained earnings. So anything on your balance sheet are going to be permanent accounts, and those will stay open. Now I pulled this example down from our previous chapter. If you recall, you can look in your notes from the previous chapter. I pulled it straight from here. We're going to use this as an example of our worksheet to show you how to close these accounts. So I just brought a copy of it down here, and we're going to use these same numbers so you can see that whole process, all of the accounting steps together. But first, what I want to do is show you kind of what this looks like in our T accounts or that ledger, because you need to verify that these temporary accounts are going to go to zero. So I'm going to go ahead and post in here in my T accounts all of my temporary accounts and their current balances before I get started in that closing process. So I have revenue. My revenue, if you look here, I'm going to find my revenue and actually all of my temporary accounts so I can make sure I bring them all into the process. My revenues have a current credit balance of $167,700. Then I'm going to look at all my expenses. My expenses start with depreciation expense. That has a current debit balance of $20,800. My salaries expense has a current balance of $52,720 in the debit side. Insurance expense is next. And that has a current debit balance of $2,500. And then I have my rent expense with the current debit balance of $37,200. Supplies expense. Notice this is not my supplies account, it's my supplies expense account. $5,300. And I have dividends. I'll bring those in after I delete this. I have my retained earnings account, which I will use in the closing process. And I have my income summary, which I will also use. Has no current balance, but I'm going to close to that. So my dividends have a current debit balance. I gotta find those of $5,200. And now I'm gonna have to get rid of this. Give myself some more room. Well, it won't delete. So I guess we're stuck with it. That's fine. My retained earnings, maybe I can just move it over. My retained earnings has that balance of $41,500. All right, now that I have everything in my T account, I'm going to go through the closing process and show you how you post these and what happens to those accounts. So first thing we have to do is close our revenue account. As you can see, it has a current credit balance. So to get rid of a credit, I'm going to debit. Revenues are closed to income summary. So now when I go and post this into their accounts, I'm having a debit of $167,700, a credit in my income summary of $167,700. You'll see this now, the account balance is 0. It closed that account. Our next step is to close our expenses. Now you can see all of my expenses have debit balances. So I'm going to debit income summary instead. And go through each and every expense and credit those to close out those balances. So I have my depreciation expense, my salaries expense, insurance expense, rent, and supplies. I'm going to just bring in these numbers from below or from your worksheet. My rent was $37. And then I'm going to just add all of these up to get my income summary amount, which if I add those up, it should come to $118,520. I'm going to go through and then post that journal entry. When I post that, you can see what happens here. What it's doing is giving each of these temporary accounts a 0 balance. So we can start fresh in the new year. My income summary, on the other hand, is going to get a debit of $118,520. So now what I want to do is find what my current balance in my income summary account is. I have more credits than I have debits, so I have a credit balance of $49,180. Now I can come up here and close out that income summary account. Again, I have a credit balance, so I'm going to debit income summary, for that $49,180, closing that account, and that gets closed to retained earnings. So I'm going to go ahead and post that in here, leaving that with a 0 balance, and then that credit is going to retained earnings, increasing that balance. So my current balance in my retained earnings is going to be, let me add those up, $96.80. And then finally, that last closing entry is to close my dividends. There's one account left open here. So dividends has a debit balance. That means I need to credit my dividends. Dividends are closed to retained earnings. A good way to remember that is we've already closed out that income summary. We can't use it anymore. So I'm going to close that to my dividends, and that's where dividends are paid out of. They're paid out of retained earnings. So that would bring that here, give that a 0 balance, and then it's going to give me a debit in my retained earnings account, which brings that balance down to a credit balance of $85,480. Now this is the retained earnings balance that we're going to carry forward, and that's a permanent account, so it's going to stay on our balance sheet. The next part of our cycle here is to understand what stays on the balance sheet, and then to kind of expand our understanding of that balance sheet. Before we do that, I forgot one other thing. Some of us do make mistakes. I make them all the time. We have to just understand how to correct that. There's my first mistake. For some reason that flipped. So if, for example, we made a mistake and we put in a debit to salaries expense when we bought supplies, we know that should have been a debit to supplies, a credit to cash, right? For $400. That's what we should have put in. Unfortunately, we debited supplies expense and credited cash. So we need to fix that. The things that need to be fixed is adding that debit to supplies and correcting that supplies expense. To do that, we're going to debit our supplies, credit our supplies expense. That should fix that journal entry, and we can move on. Now on to that classified balance sheet. Remember, those permanent accounts stay on your balance sheet. I want you to go through and just define each of these terms and what goes into them. These are our sections of our classified balance sheet. We're just expanding your knowledge of that a little bit more. Then I want you to go ahead and kind of take a second and see if you can categorize which section each of these accounts would go in, so you can make sure you understand it. So you might want to pause this video, try it yourself, and then I'll go through it with you. All right, let's take a look. Accounts payable, those are going to be paid. These are liabilities paid in the current year. That is a current liability. Account receivable, current asset. Accumulated depreciation, we know, is a contra asset account. It attaches itself to whatever asset it belongs to. Therefore, we're going to keep it in our assets under property, plant, and equipment. Cash, current asset. Common stock is part of your stockholders' equity. A copyright, make sure you understand these intangible assets. There's something we own but we can't physically feel or touch. So a copyright falls in that category. A debt investment, some people get a little confused on. It might be that we loan somebody some money for a quick turnaround. These are always current assets. Equipment falls into the property, plant, and equipment. Goodwill is again an intangible asset. What goodwill is like, say I want to buy a company. I'm willing to pay more than what it says it's worth because I really want it and I think its value will go up. The difference between what it's worth and what I'm willing to pay is the goodwill portion. Interest payable is going to be a liability, current liability. Inventory, a current asset. We hope to get rid of that within a year. Land would most likely fall under a long-term investment. A mortgage payable would be a long-term liability. Those are typically more than a year. Now, along with mortgage payable, we also have these notes payable, notes receivables. These are all possibly long-term, but a notes payable could be either current or long-term. It depends on when that's due. Same thing with a notes receivable. Depending on when we're going to get paid, it's either current or long-term. Prepaid insurance is a current asset. Retained earnings is part of that stockholders' equity. Stock investments are going to be our long-term investments. Supplies are current assets. And remember that unearned liability or unearned revenue is a liability. Most likely a current liability. So one thing just to remember for your notes, to look at those due dates. A portion of it, if it's within that year or current operating cycle, might be short term, and a portion of it might be long term. So that's just one thing you have to note. They have to tell you when those are due. So again, make sure you go through those classified balance sheets. Really focus on those closing entries. And if you have questions, please let me know.